Director, Elixir Equities, joins us now. Dipan, if indeed this correction or dip would have accelerated, this would have been one of the most anticipated and expected corrections in recent times. Is it not? People are waiting with their buying list because 90% of the people we speak to in the last 2 months were cautious. So obviously, expectation of a correction were high. Were you expecting a dip too?
See, we are in the new phase of a multi-year bull market, and such corrections are to be expected. Timing of it is difficult to figure out, but definitely I think if the market stops to go up, then automatically, you're going to have the weaker hands trying to sell off and book profits, and that is what we are seeing at this point of time. If you scan the entire news flow, there's nothing really negative so as to warrant a correction, but such is the nature of stocks. For no reason they go up or they go down, and this is what is being played out over here. And I do tend to agree with you that the bulls have been waiting for an opportunity like this. Investors who are underweight equity, who could not get money to work in the last few weeks or so, I think they will take this opportunity with both hands, especially the foreign institutional investors. I'm pretty keen to know what the FII numbers are for today evening. Because I think they are the biggest bulls in the market at this point of time, and they want to increase their exposure. They have missed out having sold through most of 22 and 23. And now that there's a risk on trade, I think they're coming back at any given opportunity, today being one such opportunity.
Taken. We have been talking about what's happening at the index level, but let's also look at some of the stocks which are buzzing around in the trading session. You have Star Cements, which is high by a good 10% today. JM Financial is holding up in the green. KEI Industries has seen a good bounce back after the cuts we saw yesterday. 5-Star continues to ride the wave. It's 4% higher. Indiabulls Housing Finance maintains the gain of around 5 to 6%. BML, Cyient, Thermax, these are some of the names which are reacting positively, and PVR and AI Engineering also reacting to its earnings. What's not doing well is clearly Redington. That stock is down 10%. And then Marksans Pharma too. There was a supply pressure that was expected today on account of that anchor lock-in opening up. So that stock is down about 5%. And then Piramal Enterprises and some other are also on the back foot, like is the rest of the markets. But the cement pack, that is what I'm going to discuss with you, Dipan, in detail, because of course there's this news flow that Sanghi Industries might be taken over by Ambuja Cement, and that's put a bit of spike in a lot of these counters. Your view on cement?
See, I think cement numbers have been mixed, in the sense that I was pretty pleased with Shree Cement numbers which came through, which were exceptionally good, and ACC also delivered a good set of numbers. But these two companies were the outliers. Broadly, what we are seeing in cement is that volume is very strong, anywhere from high teens to 20% thereabout. But there is pressure on the margins, and that's because of increased competitive intensity, which means that there are the volumes and the cost increases are there, or they may have stabilized, but there is pressure on realization, which is why we are seeing sharp deterioration in the operating profit margins. And I think this is going to be the story of cement for the next several quarters or years, if I may say. There's a massive buildup of capacity taking place within the cement industry, and every company is trying to grow as fast as they can to try and protect their turf. And we are heading into an overcapacity zone. So I'm not that positive when I see a situation like this. I'd like to be neutral to negative underweight as far as cement is concerned. And these kind of price to earnings multiple for the cement stocks are not justified, given that their return ratios are also a lot of under pressure apart from the operating profit margins. So while there'll be good demand, I'm not sure it'll be a profitable demand for the cement stocks.
It's not being violated. It was around 10,000 or 1,080 or thereabout. 70-80 bucks it has rebound from there. A lot of big new joinees are happening there. There's a management change. The stock is almost broken into the green. Would you be buyer of IT stocks in this decline, which is something already bombed out quite a lot, or maybe chemicals, another bombed out area, if it falls further from here?
No, not really. I think when I see the entire spectrum of sectors and industries which are in play, we do feel that the scope for making a decent return is better in the domestic focused companies. And we have excellent industry trends in a whole host of domestic focused companies like banking, capital goods, auto ancillary, industrial, real estate, hospitality. There are so many sectors which are inward oriented, which are focused on rising domestic spends, or because of a capex cycle picking up, or because of a cyclical industry starting to do well. So we'd like to prefer and skew our portfolio towards those sectors rather than the export oriented sectors or where the pricing is dependent upon international prices, because there's still a lot of uncertainty as to how that would really play out. And while you may get good bargains within the export oriented sectors, could be software, could be chemicals or related or similar type of businesses, but the risk return profile is not in your favor, nor are the chances of making a decent return. So from that point of view, we want to be neutral to underweight software. Same goes with chemicals, same goes with most export oriented sectors. It's just a comparative analysis, when you feel that you have got so much of certainty, visibility, and such good news and numbers coming through from domestic oriented businesses, why do you want to look at export oriented businesses at this point of time? And if you look at the GST figure which has come through, I think the only dampener in the GST is the GST on exports. So I think that gives an indication to us as to where we should be placing our bets in a market like this.
Is that you have kept ready for this down cycle?
See, as I said earlier in your show, that we are seeing very good traction in the banking NBFC space. The winners so far in this earning season from the bank side, I think, again, disclosure, we and our clients are invested, is IDFC First Bank. I think came with very decent set of numbers, well beyond their peer group. Within the auto industry, I think Maruti came with a very good set of numbers, and we are looking forward to numbers coming through from Eicher Motors. In the capital goods space, we liked Praj Industries as well as Larsen & Toubro. Excellent build-up as far as order book position is concerned. And so on and so forth. I think broadly, as I said, that we are focused more on the domestic companies per se. And these are the sort of picks that we like to go for broadly.
Sure.
And looking forward to good numbers coming through from other domestic focus sectors as well.
Sure, okay, domestic focus, we understand that, and financials. These are the two top bets coming in, Dipan. But thank you so much for joining us, gentlemen. Last